Good morning, everyone. Thanks so much for joining me this morning for Cash Flow Made Easy. My name's Kristy Bailey. I am a presenter and advisor on behalf of Business Station as part of the ASBAS program that you are part of. I'm also a business owner myself, so a lot of what we're going to go through today is going to be based on my personal experience in terms of owning and operating businesses. I'm not an accountant or a bookkeeper. So do keep that in mind. Mine really more comes from the operational side of the business. So this information I hope is valuable. Please ask questions at any time. We want this webinar to be as interactive as possible. Now you can communicate with me by using the Q&A functionality through Zoom. So pop in a question there at any time. Also, we'll have a bit of free time or a bit of question and answer time at the end of the webinar if there's anything in particular that I didn't cover or that you want to know more on. So in terms of what we're going to go through today, well, today you're going to gain an insight into the cash flow process, how you can manage that process. We'll discuss what cash flow actually is and talk about the difference or perhaps even the relationship between profit and loss and cash flow. And then you'll learn how to create your own cash flow forecast, as well as how to develop more of an analytical approach to cash management within your business. And we do that by effectively tracking your performance. Now, finally, we're going to look at strategies to stretch your cash flow further, which is always needed in small business. Now, whether you are cash positive or if you have a few cash flow concerns, there's always ways that we can look at stretching that further and hopefully resulting in a stronger position at the end of the financial year. All right, so let's get into it. What is cash flow? Well, cash flow is the term that's used to describe the amount of cash or your actual dollars that's generated or consumed in a given time period. So cash flow has a lot of different uses in both operating your business, but in also performing financial analysis. I believe it's one of the most important metrics in all finance and accounting because it really is the lifeblood of your company. It allows you to really evaluate the flow of funds in and out of the business and identify where or perhaps when there may be potential problems. So understanding cash flow is an absolute key element of your business success. If you can find out how to manage it, you can then, as we said, stretch it further. Now, profitability tends to be the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So normally you might look at a P&L on a monthly basis. It's very common to look at that at the end of a financial year. So that is really the key difference between cash flow and profit and loss or profitability. Profit is retrospective, so it looks backwards, whereas cash flow looks forwards. And particularly cash flow forecasting plans for that inflow and outflow of cash. Profit essentially indicates the amount of money that's been left over, or that is left over, I should say, after all of your expenses have been paid. And that's why we sort of generally look at it at the end of a financial year. And making a profit tends to be, essentially it's having enough sales of your product or service to cover all of your existing costs, so cover all of your expenses. And then the profit side is having that bit extra to spare at the end. Cash flow then indicates that net flow of cash into and out of the business at any particular time. So you could outline cash flow in weeks. It could be months, it could be years. It really depends on how you set up your reporting, but it also depends on the nature of your business and how the flow of cash sort of works within your business. So as we go through, I'll show you some examples, but keep that in mind. Is it important to you to know how much cash you have week to week, or is monthly a better metric? Now, why cash flow matters? Well, cash flow does matter, and it matters a lot. And I'm sure by the end of this webinar today, you will be on board with that if you're not already. But having a good or positive cash flow means that you will have enough money to pay, obviously, all of your expected expenses when they're due, which is a key thing as well. You'll know when you're able to reinvest in the business and potentially purchase capital or any other assets that you might need to grow your business or even just to run your business more efficiently. You also know when it's appropriate to return money to shareholders or take money out for yourself. And that's a really key thing. Small businesses or small business owners don't tend to draw a wage. They tend to sort of take money sporadically, but it's really important that you know when you can do that. You'll also really be assured that you've got a bit of a buffer to cover you against any future financial challenges that might arise. Now, that could be anything from unexpected equipment replacement, it could be legal expenses, anything unforeseen. You know, we've got a lot of unforeseen things going on in the small business world at the moment in terms of lockdowns and that kind of thing. So things do pop up, and having that cash flow forecast or doing this planning will give you that peace of mind that you know you can cover yourself should these situations arise. Now, having cash flow problems means that you don't have enough money in the bank for those necessary things, let alone anything unexpected. So it's really important that you identify that and you do so early. Now, you do need to keep in mind that you can have profitability yet suffer from cash flow problems. Now, that could be because clients pay late. It could be bad or early paying terms to your suppliers, so you have to pay them sooner than you sort of get the money in. And they're really the two main reasons why that happens. But you really need to figure out your cash cycle, and payment terms is one of the first things that we're going to look at to keep you cash flow positive. If you've got an existing business, it's really important to continually analyse this. So this isn't something that we do once and it's a set and forget. This is something that you continually analyse, comparing your forecast with actual results at a minimum, I would say on a monthly basis, but more regularly if that is how your business operates. If you're a startup, you might, obviously your first goal is to maintain a positive cash flow. Once that's under control, you can then look at ways that you can make it as profitable as possible. But really having that baseline and knowing what the minimum is that you need to sell within your business just to cover those expenses is absolutely crucial if you are a startup business. Now, tracking your cash flow is important, and it's sort of what we're talking about, but it allows you to operate profitably and generate positive cash flow. Otherwise, make necessary changes to improve that cash flow. So, for example, you might identify that you need to reduce certain expenses or even increase revenue in particular areas to just be able to get by on a particular time period. It'll allow you to look at what's working well and then obviously what's not working as well. And now that might be from a sales perspective. You might not be able to reduce expenses any further than they are or are already sort of sitting. So you'll need to work out what's working well and how you can sell more of your product and maybe eliminate those things that aren't working so well. You can set budgets based on what you know you need to achieve at certain times, then track your forecast and make sure that you are meeting your budget. Meeting that budget, it allows you to make sure that you have enough cash, or otherwise you might need to determine how you can get input. So you might need to personally input cash at certain times. You might need to seek out investors or perhaps even look at selling assets, getting finance, that kind of thing. Any of those things really take time to put in place. So being informed sooner rather than later is really important. Now, just on being informed, it does allow you to make informed decisions on various areas of your business. Now, that could be purchasing, and when you can bulk purchase, when you've got more cash to be able to get better deals, when you need to staff up or scale down in terms of what sales you need to make, could be leasing or renting space. Any of those things you'll need to really look at from a cash perspective. Now, with all of that knowledge, you'll be able to reach your business goals, otherwise change things so that you can realign what your goals are or find other ways to meet those goals. All right, creating a forecast. Now, because it matters so much, we obviously have to do everything in our power to increase cash flow. So forecasting and knowing exactly when you'll have inflows and outflows is absolutely crucial. To do that, first of all, you need to map it all out. Now, there are a lot of different templates that are available online. I find that the best are those available on the Australian Government website. Now that, I think it's business.gov.au. But banks and a range of other websites have them. Normally they're all downloadable, free in Excel. I'll show you an example of a forecast in a minute and we'll go through the various elements of that. But yeah, definitely find yourself a template that you're comfortable with. Once you've got that template, to get started, you'll have to look at the period of time that your forecast will cover. And then add in all the cash inflows and then deduct the cash outflows for each period. So usually it's month by month, and the example I'll show you is month by month. But as I said, you may have a business where week to week things change significantly and you really need to track cash on that basis. So it could be as comprehensive as weekly. Now, the templates on the Australian Government website do have both a monthly and a weekly. Obviously, weekly then becomes a lot more detailed because you're really plugging everything in and specific time periods. So keep that in mind. Now, if you've got an established business already, A good way to start with your forecasting is to get all of your data from previous years and input it into your forecast. So have a look at all of your expenses and your sales from previous years, pop that into a forecast, and then have a look at what adjustments you'll need to make based on past trends. So sales may have increased, they might be decreasing or even staying the same. Same with expenses. You'll go through and have a look at what they are, if they're still relevant, if they're going to be relevant in the coming year. Now, if you're a new business, or perhaps a startup, when you prepare your cash flow forecast, you're going to have to start by estimating all the cash outflows. If you do that, you'll then get an idea of how much cash needs to come in just to cover those outflows, as I mentioned before, and therefore that will give you some goals of what sales you'll need to make to cover it. Keep in mind that sales figures always change because most businesses really have various factors, that sales will depend on. Now, it could be the types of customers you've got, it could be how quickly they have to pay you, it could be economy related. So if there's interest rate increases or higher unemployment rates, does that impact how many sales you can make? You'll also have to consider what your competitors are doing and be realistic in terms of forecasting, knowing that you are forecasting based on what you genuinely think you're going to achieve. Otherwise, the cash flow forecast isn't going to be relevant. When you go and compare your forecast versus actuals, you'll then have some big differences if you haven't been realistic. Okay, so now just looking at a template. Now this one is actually not the one from the government that I've sort of recommended, but it's very, very similar. This is a bank template. As I mentioned, there are a range of different templates, so find one that suits you. Now, since cash flow is all about timing and that flow of cash, you'll have to have an opening bank balance. And you can see in this example, it's down on the bottom corner. That's the actual cash that you have on hand. So input that first. Now you then go in and add your, sorry, 2 seconds. I have just got a technical issue here. Just give me 1 second. Sorry, I've just got a computer, an error message come up. Excuse me for that. Yeah, so you'll have to add in all your cash inflows and outflows. Your inflows will include sales, GST rebates and tax refunds. It could be owner's investment of cash. So if you're going to put a bit of equity into the business, you might be applying for government grants or any other sources of funding. So anything that's coming into the business goes in that top component there. You can see there, it's called receipts in this particular example, and you've got sales and then you've got other revenues. Just keep in mind, if you've got loans coming into you or if you're planning to sell an asset or anything like that, you can absolutely put it into that area. Now, there could be franchise fees or license fees or anything incoming to you will go in the top part. Now, outflows are basically all of your running expenses. So think about anything you need, anything from insurance to, your rents or absolutely anything and everything that you'll need to run your business. But also make sure that you plan out if or when you're planning to buy new assets. If you have any one-off bank fees or loan establishment fees or anything like that, absolutely plug in loan repayments. Don't forget to account for GST payments and employee expenses. So in terms of GST payments, think about if your sales in that top part of your template actually incorporate or are inclusive of GST, then GST is going to come out, but it's not going to come out perhaps on the same month that the cash comes in, depending on what sort of structure and setup you've got. Are you paying GST monthly? Is it quarterly? Just think about that, and then make sure that the GST will then come out below in the outflows at the relevant time. Now, with PAYG and super, again, they are expenses that are related to employees. They're very known. They're not paid when you actually pay your wages. Generally, they are perhaps quarterly, monthly again. So plug them in down in that expenses section or in the outflow section at the relevant time, with the relevant timing, I should say. So it's all about timing. Now, what you'll see at the very bottom down here is your net cash flow. So you'll see that month by month. So you might identify that there's particular months where you don't make money. So your cash flow negative. But you might have had bigger months before that. So in that grey section at the bottom, that will show you how you're actually tracking. Just because you have a bad month or a month that is lower than other months, that doesn't mean that you necessarily need to input cash at that time. You may have had cash from months earlier when you're more profitable. Now, this is what I see as, this is really where it comes down to forecasting being so good for your business, in that you might begin to take out cash because you do have a good couple of months. August and September might be huge for you, so you take a bit out as an owner, but you're forgetting that November, December are going to be cash flow negative. So keep those kind of things in mind, and that's the huge benefit of forecasting. All right, so now we're going to get into the good stuff, and this is basically once you've mapped out your cash flow and you're all set up to track it, you'll identify if and when you then need to improve it. So whether there's a profit or a loss showing on your cash flow statement or your actual cash flow forecast, you should absolutely still look at ways to improve it, because improving it is going to be more profit, essentially. Now, strategies for improving cash flow fall into one of three categories. There's revenue growth, there's operating margins, and there's capital efficiency. So we're going to look at some of the key areas within those three main pillars, but it's definitely worth looking at all areas of your cash flow. So obviously looking at what's relevant to your specific business or your industry. So keep in mind, a lot of what we're talking about here is going to come back to marketing, being strategic with your marketing. But first you need to understand your position to be able to then improve your marketing and subsequently your cash flow. So there's an interesting link from finance to marketing there. Now, in terms of the three main pillars, first of all, you've got revenue growth. Now that's essentially your volume of goods or services sold and basically the price that you're selling it at as well. Your operating margins, and now that comes to your costs of goods sold, as well as your selling, general and administrative expenses. Now, your capital efficiency is really a question of how efficiently you're using your cash to operate and obviously to grow. So looking at property, plant and equipment, also looking at inventory. Now, inventory is a major one. Again, depending on the nature of your business and what sort of industry you're in, you may or may not have inventory, but inventory is a big one from a cash flow perspective. So we're going to go through and start looking at some of those elements individually now. Starting with pricing. So many businesses that I deal with, or when I first start working with them, really don't know if their pricing is right and if their prices actually cover costs. Now, the other thing that I find a lot of businesses don't know is whether specific products or services are actually profitable, or if is something that they're doing that does better than something else. So thinking about your business, do you know what are your most or even what are your least profitable products and services? If you do know what they are, can you think about how you could increase the products that are more profitable and then decrease the time and effort you're spending into and inputting into the less profitable products? In saying that, sometimes people have products that are to get people through the door. They know they're less profitable, but once they're in the door, they can upsell them and on-sell other products and services. So thinking about that as well. And then obviously understanding how much time is invested in each of your products and services. Once you've set your prices, or when you've set your prices, think about how you've set your pricing as well. So have you based your pricing on cost plus type structure, which is what it costs you, what the product or service costs you, plus a percentage markup? Or perhaps are you looking at just competition-based pricing, where you look at what your competitors are selling the same or equivalent product or service for, and then you just put a little bit extra on that, or take a little bit off, or even make it the same as your competitors? Or are you looking at just pricing based on what the customer is willing to pay, saying, I've got this product, don't really know how much it costs me, but I know that customers won't pay more than X amount for it. So none of those strategies are good in isolation. You absolutely have to look at all three elements to be effective. You can't just base your pricing on what it costs you plus the markup, because you might not be competitive. Similarly, you can't base your pricing on what the customer is willing to pay, or just what your competitors are doing, because you might not be making or covering costs, I should say, or making a profit. So keep that in mind. You have to know what your competitors are doing, but you also have to know your worth as well. I would, from a strategic marketing perspective as well, you have to identify your weaknesses and any gaps in what you're offering. And when you're doing research on your competitors, make sure that, if people are comparing you and your competitors, Are you offering a superior product or service that has, you know, that really capitalizes on your strength and perhaps on their weaknesses as well? So like I said, that's marketing strategy. What is it about your product or service that's truly unique or different, or what sets you aside from your competitors? Can you charge more because of that, regardless of what your competitors are doing? Or do you want to base your pricing on more volume and less profit? Now, when it comes to pricing, generally discounting means more work to make or maintain a margin, whereas increasing your price means less work but fewer customers to maintain your pricing. So just keep that in mind. What are you charging? What are you discounting? Also need to keep in mind that if you are increasing your price, you could potentially cut out a market. On the flip side of that, if you're decreasing your price, you could attract the wrong market. Now, we see a lot of examples with that in terms of those bulk purchasing websites. So Groupon, Scoopon, those kind of things where you drop your price, you have to give a significant discount, plus you give a commission to the bulk buying site. You will absolutely attract a huge volume of customers, but are they the right customers for you? Because you've discounted so much, are you making any profit whatsoever? Some people use that as a strategy to get customers in the door and then try and keep them loyal once you've got them through the door. But are they going to stay loyal? Are these sort of discount campaigns resulting in repeat purchases at the full price? So think about that. Also, sometimes if you drop your price, attract more customers, they might be the wrong type of customer. They might be a customer that wouldn't normally be able to afford your product or service. And therefore, you know, they're not, they don't have the same values as you as a business, or they're not as easy to satisfy as, they make it a little bit harder to satisfy them and spend less, etc. So keep that in mind. Discounting can be a very effective method of getting bulk sales, but just keep that in mind in terms of your pricing. Also, in terms of pricing, you need to understand pricing structures as well. So if you have a retail price, but then you also need to have a wholesale price, does that work through the distribution chain as well? So pricing is directly linked to distribution of your product as well. So a few elements there in terms of pricing. I would absolutely drill down so that you do understand everything about the price of your products and services in terms of what it costs you, what you're doing a competitor analysis to know what the comparisons are there, and just making sure that you've got a strategy in place around pricing. Sorry, just to go back to pricing, what I find interesting, when you're doing a cash flow forecast, you can plug in some prices, plug in some sales. Very interesting to see just a tiny shift. Like if you were to increase your products or services by $1, $5, $10, have a look at that cash flow and what changes it makes. Sometimes it makes major changes, whereas, you know, from a customer's perspective, $1 or $5 may not make a massive change. So also look at that when you're doing your cash flow forecast and play around with some figures there. All right, then looking at volume. So can you increase your volume overall? That's obviously the ultimate goal, or specifically the volume of those more profitable products and services. So to determine profit enhancement, we generally look at a few different options. Now they're outlined in that table that you can see there. The first one in blue is market penetration. Now that's where you've got an existing product in an existing market. So that occurs when your company penetrates the market in which your current or similar products already exist. So essentially you're gaining your competitors' customers, so getting more of the market. The next one you see there in green is product development. Now that's where you develop new products for existing markets. So could you launch a new product or service, maybe through what you've identified in researching your competitors? Are they doing something that that you know could be a good idea for you to introduce as well? Have you been noticing specific feedback from your customers or tracking, you know, trends that are emerging that will result in some kind of new product or service for your business that you could offer your existing customers? The next element that you see there in orange is market development. So that's where you've got existing products, but you're looking for a new market. So you're looking to develop some kind of new market broaden your scope to the international market when you currently have majority local. You could have a bricks and mortar store and you're going to go online as well, or vice versa. So think about those kind of things. Where can you sell your existing products and open yourself up to a completely new market, which will obviously result in the increase in volume. Then that last element, diversification, that's where you've got a new market and a new product. So can you spread into new areas? So sell something completely different to your existing core product that will attract a new market. There could be cross-promotional possibilities there. If you're getting this, if you've got a new product, you're drawing in a new market, maybe you could entice them with your other products or services, but essentially it's something that's complete diversification there. So think about those and just identify what your profit enhancement strategy is, or how you're going to increase that volume. Now, in terms of volume, you also have to consider what your sales processes are like. Could better processes allow you to sell more? So are there any bottlenecks in the process that stops you from a time perspective from selling more? Could you increase your advertising? Obviously, that then has a spend attached to it. But if you can really carefully choose your advertising, be extremely targeted, that could absolutely result in an increased volume. Think about if you have salespeople. Do you have salespeople? Are they good? If yes, make sure that you retain them. If not, do you need more effective salespeople? How are you going to attract them? Also look at things like a rewards program. So to get people back, think about what your repeat purchases are like, really identify what they are like, and is there any way to get those customers back. Now, from a volume perspective, and also from a marketing perspective, if you are trying to attract new customers versus retaining existing, there's a statistic that it's something like it costs you 8.5 times more to attract a new customer than it does to retain an existing. So those customer rewards programs, if they're effective at getting people back, then it's an absolutely key cost saver from a P&L or from a cash flow perspective, but it would really increase volume as well. So think about that. Now, that stats based on retail. Obviously, every industry has a slightly different statistic there, but keep that in mind. It's something interesting to definitely note. All right, the next area to improve your cash flow sits with your debtors. Now, there's a pretty interesting ATO statistic that I'll share with you, and that's that small businesses in Australia are owed $26 billion at any one time, and that's due to debtors. So thinking about that, are you part of that statistic, or do you have some pretty tight processes in place to address any issues with debtors? Now, the best ways to address those issues, in my opinion, are, first of all, to collect payments as quickly as possible. So thinking about that, what are your payment terms like? Can you have any incentives in terms of getting people to pay upfront as opposed to being on invoice? So convert them to a cash client rather than a debtor. Now, that could be through the way the payment options that you've got, or something as simple as that. The next area is to invoice earlier. So maybe don't wait to the end of the month. Send invoices straight away. Even if you've got, let's say you've got a client that purchases from you multiple times throughout a month, maybe you split that and send a mid-month invoice and an end-of-month invoice, or maybe you do your invoicing weekly so that they will get, for 1 month, they will get 4 sets of invoices. It really depends on your relationship with your clients, your nature of your business, how much you're selling, that kind of thing, as to whether or not that would work. But invoicing earlier will really get the cash back into you earlier, which helps with cash flow. Now, also, I'm not sure if anyone does this anymore. I have actually come across a couple of businesses that do, but switching from paper or posted invoices to electronic invoicing. There's some fantastic accounting software packages that will really offer some pretty strict follow-up services as well. Obviously, sending something electronically is a lot more professional than paper. They're easier to send. It's easier for your customer to store. It will really reduce turnaround times. But the follow-up is really important as well. So make sure payments are followed up promptly if they're not paid on time. The more automated that payment follow-up, the quicker you'll get paid, and the less time you'll need to input into getting payments in as well. So keep that in mind. Now, the other thing that you could consider is e-invoicing. So I'm not sure if you've heard about e-invoicing or electronic invoicing, but it's the automated digital exchange of invoice information directly between a buyer and a supplier's accounting software or systems. So it is, it's not that new, but it is sort of emerging and more companies are using it. But you won't need to generate a PDF or a paper invoice. You're basically connecting your system with the buyer's system. And basically once you're connected, the invoice drops straight in. So the network in Australia is called PEOPOL, P-E-P-P-O-L. Even I think Xero can connect through it, but basically you'll send and receive invoices that way. Now, the ATO has determined that it can cost over $30 to process a paper or a PDF email, compared to about or less than $10, they've said, for an e-invoice. So just that alone is a cost saver from a cash flow perspective. So keep that in mind. In terms of examples of companies that use it, I know the Australian government, if you're doing any work for the government, I know that they are on this system, and there are a few other big guys that are on it. So definitely something to consider. It is sort of emerging and it will be more and more common. Reducing your terms is really important as well. So make that term shorter. Don't give people 30 days to pay an invoice. Don't give them 14 days. Maybe make it 7, or as short as you can make it to get that cash in back into your business. You could even look at offering a discount for a prompt payment, or on the flip side of that, you could look at introducing late payment fees. Now, that may or may not be suitable for your business. The last thing we want to do is have any of these strategies that we're using to improve cash flow. We don't want them to impact your customer service and the relationship that you have with your customers. So think about what's most suitable to your business, but look at some kind of incentives. Now, I touched on it earlier, but make paying easy. So if you offer multiple payment methods to your customers, you give them the ability to pay you how and where and the way that it suits them. So do you have credit card facilities, as well as the ability for direct deposit or afterpay or whatever it is that's going to get that cash into you? Obviously, you have to consider fees with all of the various payment methods as well. Make sure that that your fees are accounted for in your cash flow. Absolutely. So you will have seen on that template, there's absolutely a line for bank fees and that kind of thing. But yeah, think about other payment fees. But those multiple forms of payment or multiple payment methods will just really encourage people. Let's say if you generally only invoice and have direct deposit, maybe if you do offer credit card, have a credit card, have that ability to pay by credit card, then it will encourage even your corporate customers, your B2B guys, to pay straight away. So just think about those kind of things as well. All right, assets. So assets are pretty straightforward. It's simply to think about, could you free up any cash by selling underused or completely unused assets? So I find that businesses tend to accumulate assets and at a certain point, they don't require them anymore. So if you could look at selling anything unnecessary, it would increase cash in the business. It will also save on costs such as insurance, perhaps you're storing particular assets. So think about those kind of things. You might want to also consider leasing to free up cash. So think about if that works out better for you, you would remove the cost of maintenance, the risk of complete failure, as we spoke about, that can be a major cash flow breaker. Yeah, think about that side of things. Leasing smooths out cash flow. So if it's appropriate for your business, it could be a great way to free up cash. The other thing you could do is look at refinancing or look at negotiating better terms with any existing loans or bank agreements that you might have as well. So have a look at your assets, review them annually. What have you got? What do you need? The other thing with assets is that assets could limit the amount of production that you can do as well. So having a look at not only selling underused assets, but from a cash flow perspective, and we spoke about this in terms of volume, are there any pain points or bottlenecks in your processes? One of those could be asset related. So think about that. Are your assets actually efficient enough? And would an upgrade actually allow you to produce more volume of your product or service? Expenses are really interesting, and I think a fantastic way to look at your expenses is when you first input that data into your cash flow template, into that forecast. Go back and have a look at everything you spent money on in the previous financial year. It's absolutely fascinating. You might see things there that you don't need at all. So keep that in mind. So I would go through your expenses from the forecast perspective, go through it item by item and really have a look at it. I would also have a look with expenses. Can you defer them at all, or look at better payment terms or payment plans? Insurance is a great one for that. A lot of time in terms of insurance, they will have, your policies will all be due at a particular time, but they also offer really fantastic payment plans so that you can smooth it out and pay month by month. Having a look at your premises, could you rent a cheaper location or negotiate a better deal with your current lease? Is the location what you need? Is it too big, too small? Could you look at sharing? Those kind of things in terms of what your premises is. Obviously, that's very specific to the nature of your business. But sometimes people sit in locations because they've always been there, and perhaps things have changed in terms of foot traffic, in terms of your needs as a business. Do you need a bigger warehouse? And again, could that increase in volume allow you to sell more? Is your warehouse too big? Is it in the wrong location? So all of those kind of things are really important. Looking at your expenses, have a look at, and like I said, go through item by item. But are there any cheaper alternatives to any of those expenses that are listed? So thinking about anything from technology to services that you're purchasing. So I would always look at new plans in terms of phones, technology, that kind of thing. Some of those expenses might have been one-offs that you can remove entirely. Making sure I would go through each expense and have a look at what was this expense for? Is it a business and administrative cost, or did it assist with actually selling? Was it effective? Are there any alternatives? So have a look at just reviewing things completely. Now, I would also look at, like I said, things like insurances, those things that pop up annually. Have a review of those and have a look for competitors, perhaps to the companies that you're purchasing with, and just do a bit of a comparison. Now, I would also look at the comparison between outsourcing and in-house staffing. Now, that can be really effective for specialist roles or particular tasks within a business. For example, it could be your bookkeepers, it could be marketing. From a bookkeeping perspective, perhaps outsourcing, a small amount of bookkeeping, doing your BAS and wages and that kind of thing, as opposed to doing all invoicing, which is, a lot of it's data input. So with better systems, automation, you might not need someone in-house to do that role. Marketing is a great one. There could be other administrative roles as well where outsourcing is more effective. You're basically paying for what you get then, as opposed to, and it becomes an expense rather than a liability. As employees are. So I think that's a really good element to consider as well. And we'll talk more on staffing soon. So that's just sort of touching on that area. Right, inventory. Inventory is a really interesting one. Inventory is not relevant to all businesses. So you might be service-based and you don't have inventory as such. But if you do, inventory represents cash. So if you're holding it for more than 90 days, let's say, it can really cost you significantly. Thinking about your inventory, can you source cheaper stock or materials? Always review that pricing from your suppliers and do it regularly. So I touched on that when we looked at expenses, but from an inventory perspective, have a look at what you're paying, get comparative prices from other suppliers. Even if you want to, let's say you feel very comfortable with your current supplier of a particular stock or material, you can get a comparative quote. Then still go back to your original supplier and go, we want to keep working with you, but we have been able to source the exact same product or stock or material for X amount cheaper. Can you match it? And in most cases, they're going to want to stay competitive as well. So there'll be flexibility there. Now, purchase power is really important. So when you map out your cash flow, you can see, and you really understand your own cycle, you'll see when you're able to do things like bulk purchases. Now, that will give you buying power, but you have to understand your cycle. So you map out your cash, you'll see at certain times how much stock you use versus how much you need. There could be efficiencies in terms of sales. So let's say you always sell a lot in December, perhaps, and you've got a lot of cash coming in December. Perhaps that's the month where you look at doing your bulk purchases for the following year or for the following 6 months, or however regular you need to order. So keep that in mind. I think that's really important to consider, because you will always get a better price for bigger purchases. Now, with your stock, make sure that you're maintaining the right levels. Your stock shouldn't be too high, but on the flip side of that, you should absolutely never run out, because that's going to really impact the customer experience. You need to track the movement of your stock and have those processes in place to identify when new stock needs to be ordered, so that you don't find yourself in a position where you've got none, or you're doing things in a short time frame and therefore paying a lot more for it. I would also look at your agreements with suppliers. So can you return anything that's unsold? So really understand those return policies. Now, I think as a result of COVID, a lot of suppliers really tightened down on return policies, because what happened was a lot of companies tried to return stock, and they all tried to do it at the same time, at a time when no one else was buying stock of companies. So I think those suppliers have probably really cracked down on the return policies. But I would understand the return policies of your suppliers in particular. So maybe do a comparison on other suppliers as well, and have a look. Can you choose a supplier based on price, based on return policies, and a range of other things? Otherwise, in terms of moving stock, if you can't return slow moving stock, think about how you can perhaps move it faster. Maybe you have a bricks and mortar store and you could go online as well, or vice versa, or there's, you know, other ways that you can really move stock. There's even Facebook groups that are aimed at moving wholesale bulk amounts of stock to other wholesalers or to other small businesses. So keep that in mind. A software platform to manage stock control is great. Otherwise, you just have to know what stock you've got. So if you're doing it manually, that's okay as well, but you absolutely have to understand what stock you have on hand at any given time and how long you've had it. Once you do understand this, you can replace that slow moving stock or obsolete stock with stock that has a faster turnover. So really understand what sells well and what doesn't. Also understand obviously the markup that you're getting, or the profit that's in each item that you're selling. Now, another strategy is drop shipping or just-in-time stock orders. You might be able to find a supplier that will provide you with stock only when you need it. So that way you're not wasting money paying for stock that's just sitting in your warehouse or a storeroom. You only order once you've had an order from your customer. But the risk that you run here, and there's a couple, one of them is the quality checks. So if you're not actually handling the product yourself, you can't check the quality before it gets to the customer. The other concern is delay on delivery. The last thing you want is a delay in delivery to impact again on your customer service, because from a customer perspective, they're going to review, you're going to get a lot of negative sort of feedback around orders taking too long. The other recommendation is look at your supplier terms and make full use of them. So in terms of suppliers, you might have two equivalent suppliers. One has 30-day payment terms and one has 7-day. Obviously, the 30-day payment terms is going to represent you holding the cash or not having paid for stock that you don't have the cash for. So it's almost like an interest-free loan. So have a look at your terms of trade. It does equate to an interest-free loan, so don't pay early, pay when your invoices are due, but really understand supply terms and choose suppliers based on terms as well as a range of other things, but really consider that as well. A lot of times from an inventory perspective, we're outlaying the cash as the business, you're outlaying that cash for the particular item, that piece of inventory, but the cash might not come in. If you're, let's say you're doing bulk purchases, and therefore you're holding inventory, 6 to 12 months of inventory. Normally it'll be less than 12 months, but if you're holding that bulk inventory, that is basically the delay on you getting the money. So make use of those supplier terms, of course. All right, now staffing. Now we touched on staffing, but when it comes to staffing, this is a really key area that can become a major expense for businesses. In terms of staff management, first of all, rostering to cover demand, to allow your staff to produce revenue is absolutely crucial. But on the flip side of that, you have to be really careful with overstaffing. You have to match the roster system to peak periods and then have flexible staffing arrangements in place as well. Now, I mentioned earlier about look at outsourcing. There's specialist roles that you could outsource, so you're only paying on demand as such, rather than having a full-time employee in a particular role. So I think that's really effective. Looking at the flexibility of your workers, can they have multiple roles or can they be able to multitask as and when needed? So keep in mind, let's say you've got, a bustling store and you've got someone sitting there that does marketing. Are they able to get up and start serving customers and, become someone that's actually turning over sales as well, and vice versa? You really have to understand your workers and make sure that they can have multiple roles, or at least be able to undertake certain roles in the case that they need to. The last thing you want is to have staff there that aren't able to help in times that you're busy and you're trying to make sales. Aside from multitasking or having flexible workers, making sure that you've got maximum utilization of your staff is absolutely crucial as well. So thinking about setting targets and then really maximizing the productivity of each and every staff member. So can you incentivize sales with commissions, or can you reward staff behavior that even improves cash flow? So you might have sales targets that even reduce expenditure. So let's say from a rewarding staff on behavior that improves cash flow, that is one thing, setting sales targets that reduce expenditure. So see how they can be more efficient. But also, can they try and convert their B2B customers to pay up front? So those kind of things are great as well. A great way to increase sales is with incentives and commissions, but you really have to make sure that your commissions aren't paid to your staff until you've got the payment, because otherwise you're, again, from a cash flow perspective, you're going to be the one that's out of pocket. You have a look at employing more qualified staff as well. So paying a staff member that's more qualified can seriously increase your sales as well as your customer satisfaction, which is going to create a really positive word of mouth, therefore repeat customers and even brand advocates. So on a cash flow statement, unqualified or cheaper, essentially staff might look like a quick win, but in the long run, they can be really damaging to your business. So good examples of that are in hospitality, for example, thinking about staff that you engage with that are clearly very experienced professionals in their field, and they're able to upsell and on-sell and really engage in meaningful communications with the customers. It's going to result in greater purchases and more spend per customer than someone that doesn't communicate, doesn't understand the product, doesn't have the confidence to upsell and on-sell. So I would really keep that in mind. Once you've got those amazing staff, retaining them is absolutely key. So staff turnover should be, or reducing that staff turnover should be a huge goal for your business, because it has such a serious impact to bottom line. Staff are really expensive. First of all, you've got employment costs. So just the hiring costs of placing ads, the time that you'll spend in interviewing people, even just going through the number of resumes that you might get through. Then you've got to train them. Now, training quite often starts with the buddy system, where you've got two staff members doing the one job from a training perspective. And then you've got other costs associated with training. It could be courses, it could be, anything else specific. So those costs can be avoided by reducing staff turnover. Once you've got staff that are the perfect fit for your business, that are highly trained, do everything you can to keep them, because it will save you a lot of money in the long run. And from a cash flow perspective, there'll be a huge impact. Now, I touched on this, but the repeat customers is absolutely huge here. People will go back to a business over and over and over because they like the staff member there in a lot of industries and with a lot of small businesses. So make sure that, that if you do have those repeat customers, every time they walk in, they're not greeted by someone different, because it's harder for them to build a relationship with you as a business. So keep that in mind, absolutely crucial. All right, so that's kind of the main strategies to improve your cash flow. As you go through and complete your cash flow forecast, you can keep those strategies in mind. And then when you've got to the point that you've determined if you have a profit or a loss, you'll need to make some considerations. So if you see that you have a profit, don't be too quick to take that cash out. Invest back in to manage cash flow for future months or years, or even use it to pay down debt. If your forecast shows a loss, then you'll have to obviously look at what you can do here. But first of all, you might need to consider inputting your own money. You may need to look at getting equity from investors. You might have to borrow to fill gaps. So you might need to speak to your bank about that, whether you need a business loan or even an overdraft. Now, an overdraft is a really common solution for a lot of small business to manage cash flow. So it could even be that you are a seasonal business where you have some peak periods where there's lots of cash coming in, and then you've got other times that there isn't as much, and you kind of need that overdraft to get through those times. Now, debtor cash flow issues can really be managed with an overdraft as well. Now, there's obviously fees associated with any loans overdraft. You're going to be paying interest. So if you can avoid them, that's great. But when you've done your cash flow forecast and you can really identify when there are those periods that you might need it, being planned is absolutely crucial. So if you can't get an overdraft overnight, or you can't seek investors in a short period of time, so don't wait until you're at that point where it's absolutely, live or die sort of scenario, and make sure that this is all planned out. Now, the very final step, and I believe the most important step of all, is to review your estimated cash flow or your forecast against actuals, and do it regularly. So make sure you go back and check that what you estimated and what you achieved are similar, or adjust, because it's going to, as you add that adjustment in from a forecast to an actual, it's going to change the rest of your year essentially, or the other periods within your forecast. Now, when you're doing that, you can highlight any differences between what you estimated and the actual, and see why your cash flow didn't meet your expectations. So thinking about, was it lower sales than you forecast, or perhaps was it higher expenses? Now, you might have to take different actions for different situations. So depending what the reason that you didn't meet your cash flow forecast was, you'll have to take actions. Now, cash flow is all about timing and that flow of cash. So really make sure when you are preparing your cash flow forecast, you are as accurate as possible on the timing as well. So if you sell a lot in August, but you don't get paid till September, obviously it goes in the September column. And then when you're comparing your forecast to your actuals, it's going to make a lot more sense. Keep that in mind. That's absolutely crucial as well. Okay, so in terms of cash flow mistakes, there are quite a few that I come across in my day-to-day experience with small businesses, but the most common that I see are, first of all, running a business from your bank balance. It doesn't account for any planned or unplanned expenses, or even perhaps the seasonal nature of your business, if you've got a high and a low season, or peak and quiet periods. So just because you've got a lot of cash in the bank at a particular time doesn't mean it's okay to spend it. And I do see that in small businesses where they'll go, all right, yeah, there's cash there, let's buy that thing that we needed, but what's going to happen next month, or the month after, and the month after that? I also see a lot of improper management of tax and government expenses. They are very clear, they're known, plan for them. And now that could be GST, it could be super, it could be PAYG. Now there's penalties for late payments across any of those. It's very simple to account for them, so do that in your planning stages. Spending too much money on sales is also a bit of a cash flow killer. As a small business, you obviously have to have new customers, but you have to think about what cost it is to actually get those customers. Are you tracking the acquisition cost of a customer? Are you tracking the total revenue of each customer that each customer generates, I should say, and making sure that it's higher than the acquisition cost as well? Now, overspending on the acquisition might lead to getting a small value customer, but they don't have a very big return. So keep that in mind. Don't be caught in the perception that the more customers you have, the higher your profit will be. Discounting comes into play here. You have to know your value and how much you can sell your products for, and how much you can get away with discounting, as well as how much it's costing you to actually acquire those new customers. Not forecasting is a big mistake, but you guys are absolutely not going to do that because we've just been talking about it for an hour. So I am confident that you will have taken that away from this, if nothing else. Not collecting cash fast enough is obviously a big issue. If your customer's delaying payments but your supplier turns it short, then you're the one that's caught in the middle. Unpaid invoices are also a big issue when it comes to cash flow. Now, what's worse than late payments or chasing invoices is if you don't have the proper systems in place and miss invoices here and there. So I have come across this quite a lot where a company just won't invoice you. Now, I'm always honest and I'll go through them and go, you know, you don't want that for a small business, but I will always hassle them. I've had to call someone 3 and 4 times just to get them to invoice me before. So that's a really big issue for a small business. Now, it might not be you as the business owner that is you know, forgetting these things. So again, come to trained, qualified staff, making sure that those kind of things are considered. Holding inventory for too long costs you a lot of money, which we've just touched on. Inventory is cash, so you don't want it sitting there doing nothing for your business. Now, taking too much cash out is also a bit of a cash flow issue and a big mistake for small businesses. Obviously, if you take money out of your business sporadically or even regularly, you have to know that you can afford to. I think as a small business owner, you work hard, you absolutely deserve to be taking money out of the business, but perhaps, well, definitely look at structuring that into your cash flow forecast. Thinking about how you're going to account for money that you're taking out and plan for it when you can do so. Don't just do it every now and then. Now, if you do suffer from negative cash flow, you can absolutely recover from it. So you first have to find out what's caused the issue. You'll have to change your payment terms, reduce your operating costs, run promotions to get new sales or approach new clients, and worst case, meet with a lender or an investor. So hopefully that's given you enough information to be able to develop your own cash flow forecast and really understand your cash flow a lot better. Now, if you do want to know more, keep in mind that you can book one-on-one appointments through your ASBAS login. Now, the program is changing from August, as you may be aware, so get those appointments in as soon as possible. More information on the new structure post sort of 1st of August will be released soon. But it is, I think the latest news I've heard is that it's highly likely that as an existing client, you will be able to re-sign up for the new program. If you're not sure or if you haven't heard any information from our head office yet, please just get on and book pre-book any appointments that you think you might want from a one-on-one perspective and keep joining our webinars. Now, I'm going to stay online now to answer any questions. Thank you so much for joining me. It's been an absolute pleasure. I hope that what I've said makes sense to you and that you've got something you can take out of that. And like I said, shoot through any questions that you have now. Thanks again.